Hey, come on in, everyone. Have a seat. Happy New Year. All right. NAIOP morning. It's a party. Yeah. Thanks, Nate. Appreciate it. All right. Fantastic. Welcome, everyone, to the kickoff of the NAIOP and BOMA years. This is our annual joint event, the State of the Economy event, always one of our best attended events. Thank you to our friends and partners at BOMA for continuing to partner and help us produce this event. My name is Nate Phillips. I'm the president of our NAIOP chapter and president of Chapman Properties. Again, welcome and Happy New Year. Thanks for coming to this event. We're going to spin through these announcements pretty quickly so we can leave plenty of time for our experts to tell us what all the little blue and orange lines are doing for this year. So let's get started. Thank you to our sponsors, both NAIOP and BOMA. We appreciate the support that these companies give to our chapters and allow us to bring these events. So for BOMA, the champion sponsors on the screen, thank you to those folks. And we don't care about the NAIOP. Oh, we're going to the BOMA. Here we go. BOMA events first. All right, good. Clay Shoot, May 1st. Always a nice event. Annual golf outing, August 31st. Please save the date. Valley Brook, NAIOP gavel sponsors. Thank you so much to you folks. Appreciate it. Thanks for buying the eggs this morning. Our calendar of events, just some notable dates. This is all on the website. We're going to spin through this pretty quickly, but we do have the ski outing coming up, and note the date for the February chapter meeting, and we're done. Here we go. Doesn't seem to be working. All right. Well, okay. I think there's still room for the ski outing. I think registration's about to close for that. Let's go back to, we're struggling on this one. Why don't you guys just go ahead and cruise through manually. Just some notable announcements for ski outing. Just check the website. How about that? Support the PAC. Obviously, we have a very robust legislative agenda, both locally and with the state. Thankfully, it seems like the local side might get a bit easier, but there's still a lot of work to do. Congratulations to our new mayor. So anyway, let's jump in with the program. So I am pleased to announce and bring up to the stage Gus Faucher. Gus is no stranger to this event. He's been doing it for as long as I can remember. Probably what, Gus, 8 or 9 years at this point? 2012. Gus is Senior Vice President and Chief Economist at PNC. Gus is going to start off the event with his presentation and tell us when interest rates are going to drop again. And later on, he'll be joined by Don Smith to help lead the Q&A in a bit of a fireside chat. Don is president of RIDC, a longtime member and leader of NAIOP Pittsburgh. This year, Don is actually rolling off of the board after decades of service. He finally figured out a way to get off. So thank you, Don, for your leadership of NAIOP, and he's leaving to go improve his golf game. David Caligiuri, speaking of legislative stuff, can you give us any brief advocacy announcements so we can bring membership up to date on anything happening in Harrisburg or locally? Thank you, sir.
It seems like you're going out of order, like you almost forgot about me.
Almost.
So real quick, this is an election year for our state elected officials, particularly our governor. So what that means is that for all the developers out here who have projects that need any type of economic incentives, this is your year to ask. The governor and our legislative friends love to go around the state handing out big checks. So I implore all of you to put some pressure on them, get them out and about and spending some hard-earned tax dollars. And I say that because the governor's about to give his budget address in 3 weeks. I know you're thinking he just passed a budget a few months ago, and the process is already, again, before us. It is a slow process, but again, because it's an election year, we anticipate that the budget will be done on time or relatively on time this year. And with that, that means that we're going to have to find some revenue sources. So keep on a lookout for skill games being passed in the legislature, adult use marijuana to be passed to fund what is going to be next year a fiscal cliff. And I'm sure Gus will have a lot to say about that and where we're headed next year. That's the state level. At the local level, everyone saw that we finally elected a mayor who is pro-development. I think that is exciting for all of us in this room and for what it means for the city of Pittsburgh. And yesterday, on his first day on the job, his first act as mayor was to pass or sign an executive order dealing with permitting. And yeah, congratulations. Yeah, that's great. Although I should say, let's wait and see what the devil's in the details. But I'm encouraged by that and by what our mayor has said and how he wants to support everyone in this room. So that is the update. If you have any questions or comments, please feel free to reach out. Thank you so much.
Thanks. All right, we'll wait to get the high sign from the tech folks. Appreciate your help, and we'll bring Gus up here to make sure let's see. Here we go. All right, Gus, come on up. Thanks. Appreciate it, Gus. Thank you.
And I know that this is 2012 because when I started at PNC, this was literally the first public speaking event I did when I started at PNC. I started at the end of 2011, but I did this in early 2012. So thank you very much for having me back here. It's a pleasure, as always, to speak with you this morning. So PNC does a small business survey twice a year. The latest results, this is from the fall of 2025. You can see that small business owners at the kind of fall of last year were feeling incredibly optimistic about how things were going with their own business, about the national economy, about their local economy, and so forth. The share of small business owners who was pessimistic about their company's prospects over the next 6 months, less than 1%, the best results in the more than 20-year history of the survey. So they are feeling very good about how conditions are at the end of 2025, heading into 2026. And we have had a very strong economic recovery in the United States. This is the cumulative change in real GDP, the size of the economy between right before the pandemic, the fourth quarter of 2019, and the third quarter of 2025. You can see that the U.S. economy is about 14% larger than it was before the pandemic. Second place is Canada at around 11% or so much stronger than Canada. The Eurozone's only at around 8%. German economy has barely grown since the pandemic. So when we look at other economies in the world, the United States has had a very strong performance since the pandemic. But what we are seeing is a significant slowing in the labor market. So the blue line on the left-hand scale is employment as measured in a survey of businesses. And what you can see is during the pandemic, we lost 22 million jobs. But we quickly added back all of those jobs and then added about 8 or 9 million more since then. So very strong job growth. But you can also see that that line is leveling off. So in 2023, we were adding about 220,000 jobs per month. In 2024, we added about 160,000 jobs per month. In 2025, over the last few months, we've added about 30 or 40,000 jobs per month. So we're adding a lot fewer jobs per month. Some of that is due to federal government budget cuts under DOGE. When we look at the private sector, it looks better, but even there we're seeing a significant slowing. Some of it is due to weaker growth in the labor force. With restrictions on immigration and increased deportations, we just don't have as many people available to fill jobs, and so that's weighing on the labor market as well. But a lot of it is coming from weaker demand in the private sector. And so we are seeing a significant slowing in job growth, and we've also seen the unemployment rate increase. So it's around 3.5% before the pandemic, jumped up to almost 15% in April of 2020 with the pandemic, then fell very sharply. It hit 3.4% briefly in 2023. That's the lowest unemployment rate we've had in more than 50 years. But now, as of November, it was up to 4.6%. So still historically low, but definitely more slack in the labor market than what we have seen through most of the past few years. We do get the December jobs report on Friday. I expect that we'll see, again, moderate job growth of 30 to 40,000, unemployment rate holding steady at 4.6%. So the labor market is still good, but it's not as good as it was a couple of years ago. And then obviously one of the big things weighing on the economy are tariffs. So tariffs are a tax on goods that are imported into the United States. The blue line is the historic tariff rates. Tariff payments as a share of goods imports into the U.S. And you can see that for the last 50, 75 years, that has been in the low single digits. In 2024, it was about 2%. Now, we've seen, obviously, there have been a lot of tariffs imposed and then withdrawn and then reimposed and so forth. But when we look at where tariffs are at the end of 2025, if we assume that the distribution of tariffs is the same as it was before all this happened, the tariff rate would be about 18%. But obviously, if we put higher tariffs on goods from China, we're going to import less from China, more from other countries. If we put tariffs on steel and aluminum, we'll import less steel and aluminum, more of other things. So then the effective tariff rate is only about 15%. But we're still talking about tariffs that are 7 or 8 times higher than they were in 2024. That's a tax increase of somewhere between 1 and 1.5% of GDP. And that is weighing on consumers, it's weighing on businesses in late 2025, early 2026. And although the Fed has been cutting the Fed funds rate, interest rates are still a lot higher than they were a few years ago. So the blue line is the yield on a 3-month Treasury bill, a short-term interest rate very closely tied to the federal funds rate. You can see that that was basically zero in the aftermath of the pandemic as the Fed cut the Fed funds rate down to zero in an effort to support economic recovery. Then with high inflation in the recovery, the Fed raised that Fed funds rate very aggressively. It got up to above 5% by 2023. Then the Fed eased somewhat at the end of 2024, but the Fed was still concerned about inflation. We saw some easing this year, or last year, excuse me, at the, between September and November of 2025. We saw the Fed cut the Fed funds rate by a cumulative 75 basis points. And so it's now in a range between 3.5% and 3.75%, lower than it was a couple of years ago, but really much higher than it's been ever since the Great Recession back in 2007, 2008. When we look at longer-term yields, the orange line on the right is the yield on the 10-year Treasury note, and that's the basis for long-term borrowing costs in the economy and mortgages and so forth. You can see that that got down below 1% in the immediate aftermath of the pandemic as the Fed worked to push down long-term interest rates. But then with the recovery with high inflation, that was bouncing around between 4 and 5%, and it's been there for the past couple of years. Really not much progress. Even as the Fed has been cutting short-term rates, that's been having very little impact on the long end of the yield curve. That's much more determined by inflation, by expectations for economic growth, and so forth. So we have both short-term and long-term interest rates that are much higher than they've been for a couple of decades, and that is indeed weighing on economic activity, and in particular, it's weighing on the real estate industry. But even with all of this, we've seen a very strong stock market. So you can see that big drop in stock prices in April of 2025, around Liberation Day. They fell by about 19%. The blue bars are the S&P 500. But as the economy has continued to hold up, as the Fed has eased somewhat, we saw record highs yesterday in the Dow Jones Industrial Average and the S&P 500. So the stock market is pricing in continued growth in the U.S. economy going forward, continued growth in corporate profitability going forward. Volatility now, the orange line on the right-hand scale, that's volatility in the stock market, how much stock prices are moving up and down. You can see it's a little higher than it was a couple of years ago, but not nearly as high as it was surrounding Liberation Day, as we've gotten a little more clarity about what the administration is trying to accomplish. This shows 3 measures of economic activity. These are adjusted for inflation. I set the fourth quarter of 2019 equal to 100. What they show is that basically the U.S. economy contracted between 8 and 9% between the fourth quarter of 2019 and the second quarter of 2020 when things were at their worst with the pandemic. We are producing about 8 or 9% fewer goods and services a couple quarters after the pandemic than we were before the pandemic. But now you can see again the U.S. economy is about 14% larger than it was before the pandemic. That being said, the progress has been uneven, and I realize that this is a little bit complicated, but let me try to explain this. So again, these numbers are adjusted for inflation. I set the fourth quarter of 2019 right before the pandemic equal to 100. So you can see the blue line is consumer spending on services, education, healthcare, travel and tourism, personal financial services, those types of things. Housing, those fell by about 15% immediately after the pandemic. We weren't going out. We weren't going to the movies. We weren't going on vacation. We put off discretionary visits to the doctor. But as the economy has reopened, we've had very strong growth in consumer spending on services, and it's now about 15% higher than it was before the pandemic. The orange line is consumer spending on goods. So either big ticket items like cars and appliances or non-durable goods, food, clothing, medicine, gasoline, those types of things. When we were all stuck at home, we ordered things on Amazon, right? Anybody here buy a Peloton during the pandemic? Okay. Have you bought another Peloton? No, seriously. Have you? How many Pelotons do you need, right? So you can see that we had a big surge in good spending initially because we were all stuck at home, but then it was flat for a couple of years, right? Because we don't bought Pelotons and we didn't need to buy another one. But as those goods have worn out, we started to buy more, and now we see good spending that is about 25% higher than it was before the pandemic. The green line is business fixed investment. That includes commercial construction. And you can see that that has been very strong. Interest rates were low. Businesses had trouble finding workers, so they hired. We saw a lot of commercial development. Even as interest rates have gone up, we've seen strong growth in business fixed investment, but a lot of that is taking place on the tech side, and I'm going to show that in a few minutes. We've seen weaker growth in commercial construction, so forth, as high interest rates have been a drag there. Residential investment, that includes both single and multifamily home building. You can see that there was a surge in residential investment. After the pandemic, people were moving, after they'd been stuck at home, they were, younger people were moving out of their parents' homes and renting apartments. We saw very strong multifamily construction. Mortgage rates were below 3%, so there's a lot of single-family construction, a lot of repairs and renovations. But as interest rates, as mortgage rates went from 3% to close to 7%, you can see that that's leveled off. And in fact, residential investment, is below where it was before the pandemic. And then finally, the key to the entire thing is the red line, after-tax personal income. That's the income going to households from the labor market, from investment returns, and from government transfer payments. And what you can see is that even in the second quarter of 2020, when things were terrible and we lost those 22 million jobs, after-tax personal income was 10% higher adjusted for inflation than it was before the pandemic because the federal government stepped in and provided stimulus payments to households. And then we saw an additional surge in early 2021 with additional stimulus payments. But then those payments expired, inflation was high, after-tax personal income fell. But since then, as the labor market has continued to improve, we've been adding jobs, wages have been growing more quickly than prices. We're seeing moderate growth in household incomes, and consumer spending makes up 2/3 of the U.S. economy. So as long as the economy continues to add jobs, we will continue to see growth in after-tax personal income, growth in consumer spending, growth in the overall economy. In terms of the inflation outlook, we saw a surge in inflation with the pandemic. Supply chain issues, very strong demand for goods, difficulty in getting goods into the U.S. economy. So you can see that we had very high energy inflation following the Russian invasion of Ukraine, very high goods inflation. But I want you to focus on the blue line, which is core services, services excluding food and energy. So that's things like education, healthcare, housing, travel and tourism, and so forth. You can see that that surged later in 2023. That's more of a labor market story. We had a tight job market, driving up wages, driving up services prices. It's eased somewhat since then, but is still running ahead of its pre-pandemic level. And then more recently, you can see that we've had a slight reacceleration in goods inflation, in part because of tariffs. And because of that, we are seeing inflation that is above the Federal Reserve's 2% objective. Depending on the measure, inflation is running somewhere between 2.5%, 3%. So that's higher than the Fed would like. And so the Fed is trying to weigh the balance between the softness that they're seeing in the labor market versus the fact that inflation is still above their 2% objective. And so that's why they've been cautious in cutting interest rates over the past few years. How many of you hear the stories out there about consumer debt being at record high levels and how terrible this is? Okay? It's not as bad as people make it out to be, because yes, when we measure it in dollar terms, consumer debt is at a record high, but so are jobs, so are wages, so are incomes. The orange line on the right-hand scale is consumer debt payments relative to after-tax income. And you can see that that is higher than it was a few years ago when household incomes were juiced by stimulus payments, but lower than it was before the pandemic and much, much lower than it was heading into the Great Recession. So when we look at consumer balance sheets in aggregate, they still look pretty good. Debt payments relative to incomes are still pretty low. Households paid off their high interest rate credit card debt with their stimulus payments. They refinanced their mortgages, and so, people have mortgage rates of 3.5%. And so debt payments relative to incomes are pretty low historically. But we are seeing some signs of distress among lower middle income households in particular. So I want you to focus here on the blue line. That is the bottom quarter of wage earners in the United States. The people who have wages in the bottom 25% of the wage distribution. The percent change year ago in their wages. And what you can see is that, during the second half of the last decade, and then following the pandemic, that group was actually seeing the strongest wage growth. They were benefiting from that very tight labor market that we had post-pandemic. But as job growth has slowed, we have seen wage growth for that group weaken substantially, and now they're seeing the slowest wage growth compared to higher earners. And so we are more concerned about what's going on with lower income households, lower middle income households, as the softening in the labor market that we've experienced over the past few years has hit them harder. Okay. We still do have a structurally tight labor market, however. This is the labor force participation rate, the share of adults who are either working or looking for work. And you can see that, first of all, it's been declining over the longer run because of the retirement of the baby boomers. Fell sharply during the pandemic, recovered somewhat, but still was below its pre-pandemic level, and has been falling over the last couple of years due to both the aging of the workforce, but also more recently due to restrictions on immigration. And so we're seeing a structurally tighter labor market now than we did before the pandemic. And with that, we see that layoff activity in the U.S. economy is very low. The blue line on the left-hand scale is layoffs in the private sector, so this doesn't include the DOGE cuts, but layoffs in the private sector is a share of total employment. And you can see that that has ticked up over the last couple of years, but is still below its pre-pandemic level. And with the tight labor market, businesses are concerned that if they lay workers off, they won't be able to rehire. So they're being very cautious in managing their workforces. However, what they are doing, the orange line on the right-hand scale, is they're hiring a lot less. So maybe they're managing their workforce through attrition. So somebody leaves and they don't replace her. So we are seeing significantly slower hiring in the U.S. economy. That's contributing to weaker job growth. But layoff activity is low. Initial claims for unemployment insurance remain very low. And as long as the job market continues to hold up, then again, we'll see consumer incomes rising, consumer spending going up, and the overall economy should continue to increase. One of the things that's been a big contributor to economic growth over the past few years is tech investment. So this is investment in communications and power equipment, information technology, computer equipment, and so forth is a share of the size of the overall economy. You can see that surge that we've had over the last couple of years. It's basically gone from, what is that, probably about, 2.6% to above 3%. So we've had very, very strong growth in tech-related spending over the last few years, largely due to investment in AI. That's great. That's supporting economic growth at a time when we're seeing weakness in other areas, in commercial construction, in housing, and so forth. But it does mean is that a lot of our growth is dependent on tech. And if we see a pullback in tech, then that could cause problems for the U.S. economy. So we're watching that very closely. And, we did have something similar happen in the late 1990s, right? There's a lot of tech spending then. We saw the tech bubble burst. I think this tech spending is more sustainable than the tech investment that we saw in the late 1990s, but certainly a lot of the gains in the stock market have been driven by those big tech companies, NVIDIA and so forth. And so we're watching that closely, and that is a potential concern for the economy in 2026. One of the factors that will support the economy this year is the One Big Beautiful Bill. So the blue bars are the Congressional Budget Office's estimates of the federal government deficit before the One Big Beautiful Bill. The green bars are post One Big Beautiful Bill. And what you can see is that we are expecting larger budget deficits, particularly over the next couple of years with the One Big Beautiful Bill. There are tax cuts, the corporate income tax cuts, the personal income tax cuts that were included in the bill. They're going to support growth in the near term. Now, over the longer run, we're concerned about larger government budget deficits, its impact on interest rates, and so forth. But I think in the short term, the One Big Beautiful Bill should support a bit stronger economic growth over the next couple of years. But we do have some concerns about the economy, and one of them is what's going on with the yield curve. And so if you remember the chart that I showed you at the beginning, for usually we have, I work for a bank. I'm not a banker, but, I've learned a little bit about these things. When banks lend for a longer period of time, they're taking on more risk. So usually we have short-term interest rates are lower than long-term interest rates, right? If you take on more risk, you lend for a longer period of time, you want to be compensated for that risk by charging a higher interest rate. If you remember that chart that I showed you at the beginning, we showed that short-term interest rates went up a lot when the Fed tightened. Long-term interest rates went up some, but we had a situation where short-term yields on treasuries were above long-term yields on treasuries. That's the inverted yield curve. You've all heard about the inverted yield curve, okay? That's when these lines are below the axis, when we have short-term yields above long-term yields. Now, if you remember, we showed that as the Fed cut, we saw short-term yields move back down below long-term yields. And so these lines are now back above the axis. Well, why do we care? Those gray bars, can you see the gray bars in the back? Okay. Those are recessions in the U.S. economy. And what you can see is that when the yield curve inverts, when we have short-term yields above long-term yields, we almost always get a recession. And that's why we followed the yield curve very closely. Now, the yield curve is reverted, right? We now have long-term yields that are back above short-term yields. You may be thinking, oh, that's good. Well, that doesn't mean that we're in the clear, because you can see that oftentimes the yield curve reverts and we still get a recession shortly after that. And we did have a long and deep inversion in the yield curve, in 2023, 2024. Now, not saying a recession is going to happen, but certainly it could be that the yield curve is still trying to tell us something. And we have a global economy that is at serious risk of recession. Just like we had high inflation and the Fed aggressively raising interest rates in the United States, we had a similar situation all over the world with the Bank of Canada, Bank of England, European Central Bank, and so forth. And now those central banks have started to ease like the Fed has, but just like interest rates now in the U.S. are a lot higher than they were a few years ago, that's the case globally. And then you add on top of that the trade war that we're experiencing, and you have much of the global economy that's at risk of recession. This comes from my former employer, Moody's Analytics. So you can see that most of the global economy, particularly when you look at it based on the size of the economy, is at risk of recession in late 2025, early 2026. We can have a global recession without a U.S. recession, but it does make the U.S. economy more vulnerable to some other type of shock that could push us into recession. So this is our forecast. Our forecast is for a bit slower economic growth in the near term. Thank you. The blue line on the left-hand scale is real GDP. So a bit slower economic growth in the near term as we're seeing a softening in the labor market with restrictions on immigration and so forth, but not an outright recession. And then we do expect that the unemployment rate, which again went from around 3.5% to 4.6%, it's going to stay right around that level over the next year or so. We do expect that the Fed will cut sometime in 2026, probably not imminently. The minutes from the latest Federal Open Market Committee meeting indicated that the Fed is concerned about cutting interest rates given that inflation is still above their 2% objective, and we didn't make much progress. But we do expect that the Fed will cut, but maybe only once or twice in 2026. So short-term rates may move a little bit lower in the near term, but I don't think long-term rates are going anywhere anytime soon, given that we still are running large federal government budget deficits and that inflation is still above the Fed's 2% objective. And the risks are still weighted to the downside. You know, we have to add to this what's going to happen with the situation in Venezuela. But we still have tariffs out there. The restrictions on immigration are weighing on labor force growth, and that could weigh on overall economic growth. Spending cuts under the One Big Beautiful Bill could be a drag. I'm concerned about a correction in the stock market. As I pointed out, a lot of the growth has been tied to what's going on in tech. If we see prospects for tech companies weaken, we could see a big decline in stock prices. That could be a drag on business investment. It could be a drag on spending by high-income households that have a lot of their wealth in the stock market. So I think a lot of those risks are weighted to the downside. There are some upside risks in terms of deregulation and so forth, but I think generally the risks are weighted to the downside. I'd put the probability of recession over the next year at about 1 in 3. Normally, it's about 10, 15%, so elevated because the risks weighted to the downside. When we look at the commercial real estate market, these are property price indices. I set the fourth quarter of 2019 right before the pandemic. You can see that we've had very different dynamics across very different property types. So industrial space still looks pretty solid, still strong demand for warehousing space and so forth. Multifamily, you can see that big surge in multifamily pricing coming out of the pandemic as we saw a lot of people moving, in particular into rental properties. But then we had a big multifamily building boom. Interest rate, so we had a lot more supply on the market. Interest rates went back up. And so we've seen a decline in multifamily prices over the last few years. And then office, you can see, has definitely been the laggard. Concerns about the sustainability of office using employment and so forth, dragged down further by higher interest rates. So that has been, offices have definitely been the laggard in the commercial real estate market. But the good news is that we are seeing a stabilization in delinquency rates for commercial real estate. So we did have a little bit of an increase in delinquency rates, but I think banks have been very good with their lending standards. We've seen banks and their borrowers working issues out. So when we look at delinquency rates for commercial real estate, they actually are pretty low and certainly not indicative of significant problems in the commercial real estate market. Let's talk about regional economic conditions. This is the Philadelphia Fed's coincident index. These are how things stood as of September of last year. Some of the data has been delayed by the pandemic, so we don't have anything more recent. But what you can see is that most of the economy is in expansion, and Pennsylvania is seeing slower growth, but still positive growth. So we are seeing expansion in Pennsylvania. this is employment. I set right before the pandemic equal to 100. You can see that nationally employment is about 4% higher than it was before the pandemic. In Pennsylvania, it's about 3% higher. In Pittsburgh, I checked the numbers. I think it's like, I don't know, we're down, maybe 1,000 jobs or something from before the pandemic, but we're still not back to our pre-pandemic level in terms of employment in Pittsburgh. And it's not a labor demand issue, it's a labor supply issue. The orange line on the right-hand scale is the size of the labor force in the Pittsburgh metropolitan area. So Allegheny, Armstrong, Beaver, Butler, Fayette, Lawrence, Washington, Westmoreland counties. And what you can see is that we have, about 40,000 fewer people available for work in the Pittsburgh metropolitan area than we did before the pandemic. So businesses want to hire, but they can't find the workers, and that's the biggest constraint. And then you can see the U.S. labor force actually grew pretty strongly following the pandemic. It's leveled off more recently because of restrictions on immigration. But businesses can't find the workers that they need here in Western Pennsylvania, so they search elsewhere, and that's where they're hiring. Pittsburgh has an older population. It has a more stable population. So we tend to see smaller swings in house prices in the Pittsburgh metropolitan area relative to the rest of the country. So nationally, when prices were going up 20% a few years ago, they were going up 15% in the Pittsburgh metropolitan area. When prices weren't growing nationally, we were still seeing weak growth in the Pittsburgh area. So milder house price swings. And then I show this every year. This is still the most important chart that I'm going to show you. Basically the Pittsburgh population was flat from 2023 to 2024. That's actually good news for Pittsburgh because usually it's contracting. So we have an older population. We tend to see net outmigration, more people leaving the Pittsburgh area than coming into the Pittsburgh area. And then you add on top of that restrictions on immigration. And so we are going to continue to see a declining population in the Pittsburgh metropolitan area, and that's going to be a drag on growth, and that means that the Pittsburgh area will be growing more slowly than the national economy over the longer run. Thank you very much for the opportunity to speak with you this morning. I always appreciate it. You can see our materials at pnc.com/economic reports. You can follow me on X, formerly Twitter, at Gus Faucher PNC. So thank you. And with that, let's bring up Don. Thanks.
Well, thank you, Gus, for that really good presentation, and welcome, everybody. Good morning. Actually, Tom Frank told me to take this off. If you're with NAIOP long enough, you get a lot of ribbons, and he was afraid that Pete Hegseth would mistake me for a third world dictator and order an extraction. Gus, lots of great information, and I have to say, in the beginning of your presentation, I was like, I feel better about the economy now than I did. And then you got to the end and I said, oh, man, maybe not. But, let's talk a little bit about Pittsburgh. What structural economic shifts, whether it's demographic, technological, or capital market driven, are really most impactful for Pittsburgh, and kind of what impact are they having?
I think the biggest is the demographics. So we have since the decline of the steel industry back in the 1980s, we've had an older, we had a lot of people move out. If you talk with Chris Bream from the University of Pittsburgh, Chris will tell you that because of the exodus of people in the 1980s, those people didn't have children in the Pittsburgh metropolitan area, so it continues to be a drag on economic growth here. So we have a much older population than the rest of the United States. We tend to see negative net migration. We have more people leaving the Pittsburgh area than coming into the Pittsburgh area, and you add on top of that restrictions on immigration, and so we do expect that we are going to see weaker growth in Pittsburgh compared to what we have nationally. Now, we do have some advantages. We have the universities, I think, which are a huge resource. We have a very strong healthcare industry. One of the advantages Pittsburgh has is it tends to be less cyclical. So as the Pittsburgh area economy has transitioned away from heavy manufacturing towards education and health services, towards financial services, we tend to see less variability. So when there are recessions nationally, the impact tends to be more limited in Pittsburgh than in the rest of the country. The flip side of that, however, means that when we see expansions, we see slower growth in Pittsburgh relative to the rest of the country. So the industrial structure. And then I do think that obviously, Pittsburgh does have some big advantages. I showed that chart on tech investment. Obviously, with our universities, with our research institutions, I do think that that tech investment does hold tremendous potential with the robotics that we're doing here and so forth, that I think, we do have the opportunity to get some of that tech investment here, bring in talent, and that could be a long-term growth driver for the Pittsburgh area economy.
Great, thank you. So tariffs and immigration, both things tend to be inflationary. And yet we're not seeing strong rebound in inflation. But the flip side of that, it was supposed to really encourage reshoring of manufacturing. So are we seeing a lot of reshoring of manufacturing? And in the Pittsburgh region in particular, our manufacturing performance in the last 10 years hasn't been great. Are we seeing any changes in that?
Yeah, so let me comment on the inflation aspect of it first. It is true that we have not seen a resurgence in inflation, but normally by this point we would have expected, given that the Fed has been tightening that monetary policy is a lot tighter than it was a few years ago, inflation has been above the Fed's objective since the pandemic. And we did have a significant slowing in overall inflation in 2023, 2024, but we really didn't make any progress on inflation in 2025. It's still higher than the Fed would like, and it didn't get any closer to 2% last year. And I think some of that is due to tariffs. There are other impacts as well. When we look at goods inflation, a couple of years ago, goods prices were falling. Now goods prices are rising slowly, but they're rising. So I do think that tariffs are having an impact there. I think the impact of tariffs is going to fade in 2026, and so we should see lower inflation by the end of the year, and that may allow the Fed to cut, let's say spring, summer of 2026 as inflation starts to slow again. But I think that there is some tariff impact that we're seeing out there. And also when I talk to our business contacts, what they're saying is they're trying to hold the line on pricing. Their costs have gone up. They don't want to increase prices for their customers, but they're seeing that in their profit margins. And at some point, I think we are going to see businesses passing along more of those price increases to their customers. So what was the second part? Sorry.
The manufacturing and reshoring.
The manufacturing. Yeah. So, when we look at manufacturing indicators, manufacturing is still weak. We continue to see job losses in manufacturing. The ISM manufacturing index remains in contractionary territory. So we are not seeing, really any rebound in manufacturing tied to the tariffs. I think so much of it is tied to the uncertainty, right? I mean, are you going to make these are billion-dollar decisions that companies are making. There's no guarantee that tariffs are going to stay at the same levels, and with the bouncing around that we've seen in the exemptions and so forth. So it's difficult for businesses to make a decision about that with all of the uncertainty, all of the volatility that's out there. And this could change when a new administration comes in a few years. So I think businesses or the Supreme Court could overturn the tariffs sometime over the next few months. And the administration has said, well, we have other alternative ways of imposing tariffs, but they're going to be more complicated and so forth. So I think the uncertainty in and of itself is somewhat of a drag on all of this. Businesses might be more willing to make that investment, but they're not sure that those tariffs are going to persist. And I think what we're seeing in the Pittsburgh area is similar to what we're seeing in the rest of the country, which is, manufacturing employment stable to down slightly. Obviously we've seen talk about U.S. Steel and investing in the area now and so forth. But it's just particularly given the labor force issues in the Pittsburgh metropolitan area, manufacturers tell me they want to hire, but they can't find the workers. And so that's going to be a drag on Pittsburgh area manufacturing over the longer run.
Great, thanks, Gus. And folks out there, warm up with your questions because we'll get to Q&A from the audience here. So start thinking of your questions. So you mentioned tech and AI. So a lot of us here in the business of building spaces or trying to maintain and lease spaces for companies. What sectors do you think are actually going to be the growth drivers for the Pittsburgh region?
I think it's going to be a lot of the, some of the data centers. I think, we still have access to lower cost natural gas here, which I think is a big advantage. And so the energy is, obviously the cost of energy is going to be a big factor, so that could help inciting data centers. But I think a lot of the fundamental research and the spin-offs that will occur from that, I think are going to, that's where I think Pittsburgh's really going to benefit. That's where we have a comparative advantage, is in that basic research that's taking place at CMU, that's taking place at Pitt and so forth. And so I think that really offers opportunities, the robotics that we're seeing here and so forth. So I think that, Pittsburgh really has some significant advantages that I think could be big growth drivers over the longer run. And part of it is that these are, these tend to be very high-paying jobs as well. So it's not just a driver of job growth, but it's a driver of income growth as well.
Great, thank you. So Gus, if we're convening this panel and you're doing it for what would be the 15th year in 2028, what one measurable outcome would signal that Pittsburgh's economy is on a stronger, more resilient path?
I think it would be that chart that I showed you with the labor force, and the fact that the labor force here is significantly smaller than it was before the pandemic. I think even if we were to see the labor force stabilize, given the trends that we're seeing at the national level, I think that would be good news for the Pittsburgh metropolitan area. That means that we're continuing to draw people into the economy, that they're contributing, that we're at least replacing the older people who are going to be retiring, and that is going to hit the Pittsburgh area hard with our older population. So if we can see a stable labor force, maybe even a positive labor force growth, then I think that would be an indication that the Pittsburgh economy is doing better and is poised for continued improvement over the longer run.
Okay, last question that I'm going to ask, and then we're going to open it up to the audience. But I was trained as an economist as well, and we were taught that you can't run long-term deficits forever without crowding out private investment, without increasing interest rates, without hurting the economy. If we go back to a president, some of you may remember Bill Clinton, we actually had a surplus. Mm-hmm. And before that, Bob Dole was a hawk on deficits. Mm-hmm. We seem to have completely forgotten about trying to control deficits in any way at the state level, the city level, or the federal level. Mm-hmm. I mean, is that a worry?
It is a worry. So first of all, I was at the Treasury Department during the Clinton administration as a civil servant, and we were thinking about what are we going to do when the U.S. government pays off all its debt. And not only are we running budget surpluses, but we don't have any treasuries to issue, and how are financial markets going to respond to that? What are we going to do? I don't think that's a concern anytime soon. Obviously, there is no appetite in Washington right now for fiscal restraint. You don't want to be the politician who goes out there and tells people either we're going to cut your spending or we're going to increase your taxes. That is not politically popular. And there's no question but that, one of the reasons, there are myriad reasons, but one of the reasons that we have not seen long-term interest rates recently come down commensurate with what the Fed is doing because of concerns about longer-run federal government budget deficits. It's making, one of the reasons the president is pressuring the Fed to lower rates is because that will lower the government's interest costs and reduce government budget deficits. I am concerned that continued long-run budget deficits will push up long-term interest rates and weigh on long-run economic growth. I'm concerned about the possible lack of independence at the Fed. One of the reasons the United States economy has done so well since the pandemic is that we had more aggressive monetary policy from the Fed. The Fed responded very aggressively. I am concerned that, if we see political pressure, the Fed lowers rate, inflation remains consistently above their 2% objective, the Fed loses credibility. That could cause a loss of investor confidence in the United States, both domestic and international. I don't think that the dollar is going to remain the global reserve currency going forward, but we are seeing international investors in particular showing less interest in the U.S. economy as we've seen the U.S. turn more inward. And foreign investors are concerned about that. I think a lack of Fed independence on top of that, would be a significant problem and could push up interest rates in the U.S. over the longer term. So I am concerned about long-term, large government budget deficits are going to do. Now, let me add that I think that one of the factors that could offset that is AI. And I do think that AI allows for what we call productivity growth. Workers are more productive over time, so that could offset some of that impact of large budget deficits, but we can't count on that happening, and I certainly am much more concerned about budget deficits now than I was a few years ago, particularly given that our financing costs are so much higher with higher rates.
Okay, and last question, so get ready. So we have a brand new mayor, a mayor that I think a lot of people in this room are very excited about, who's so positive about Pittsburgh, who is pro-growth, whose first act was to do a permitting reform process, something we complained about here every year for the last 100 years. And so what advice would you give the mayor as, like, if you really want to see growth in Pittsburgh, what are the things that we can do locally to help stimulate that?
I think that one of the issues is housing. I think that that's a huge issue. I was talking with a Harvard housing economist last year, and I said, "Is it a problem of not building enough housing or not building enough affordable housing?" And he said, "Yes." And I think that that's true. We need more market rate housing, but we also need to focus on affordability. So we need to focus on both of those components. So I think that could be a big factor. And then the other thing is that we need to be more welcoming to people. And I know that there are groups in the Pittsburgh area that are doing this, but we need to keep our young people here who are graduating from our colleges and universities. We need to encourage people who are, looking at moving to come to the Pittsburgh area. The competition for immigrants is going to get even more intense. But you think about the Pittsburgh economy, 125 years ago, it was built by immigrant labor. We have gotten away from that, but we need to do everything that we can to encourage young people, domestic immigrants, international immigrants to come to the Pittsburgh area to build that 21st century labor force that we're going to need.
Great, thanks. So we'll open it up. Erica has a microphone. If you have a question, raise your hand and she'll find you with the mic. Well, Aaron, you're loud. You can do this.
Yeah. We'll repeat the question.
How concerned are you in Q2 with the chairman of the Fed leaving his post and a new, Fed chair coming in? How much impact will that have on the economy, especially in the second half of 2026?
So the question was about the impact of the new Federal Reserve chair coming in. As I pointed out, I think that Fed independence is huge. And I think that is a big reason why the U.S. economy has done well during the recovery from the pandemic, but even over the longer run in the entire, post-World War II experience. I think that we have learned the advantages of having an independent central bank, a bank that is willing to raise interest rates, even if political pressures are against that because of concerns about inflation. And I think we saw in 2022, 2023, how devastating high inflation can be. We have not had that experience, for 40 years in the United States with inflation getting to those levels. And it really is detrimental to the economy over the longer run if it's allowed to persist. So I think Federal Reserve independence is very, very important. I am optimistic that the Fed will continue to resist political pressures. The way the Fed is structured with staggered terms for members of the Board of Governors. You have the regional presidents who are appointed via a different process and so forth. So I am, even if the president were to appoint someone who would do his bidding, I think it would be very difficult for that person to sway the entire Federal Open Market Committee. And I am hopeful that the Fed will retain its independence and focus on its dual mandate of stable prices, which they've defined as inflation of 2%, and maximum employment, get inflation back down to 2% over the longer run, and then that sets the stage for long-term economic success. I do think that the Fed has the opportunity some point over the next few years to reevaluate. We've been through a lot since the pandemic, since the Great Recession. And so I think it would make sense for the Fed to look at are we focusing on the right thing? Should our inflation objective be 2%? Should it be 2.5%? Should it be a range between 1.5%, 2.5% or so? So I think that there's a chance for reevaluation there in the context of an independent Fed that is focused on its dual mandate.
Thank you. Yes, sir.
Quick question, Patrick Conley here. In regards to your number one indicator of labor, pre-pandemic to post-pandemic, how is that number actually calculated considering the remote workforce, and how does that play into it with people either living here and working in other cities or people living in other cities and working here? How is that recorded?
A great question. So there are actually two surveys of employment in the United States. There's the establishment surveys. That's based on where the employee is located. Okay, so the establishment survey, that's the one that shows that Pittsburgh, the number of Pittsburgh jobs is basically just below its pre-pandemic level. That is based on people who physically work in the Pittsburgh metropolitan area no matter where they live. Okay. The labor force number, that comes from a survey of households. That's based on where the person lives. So not where they necessarily work, but where they live. So that could include remote work, for example. But I think no matter what, whether we look at the survey of households, whether we look at the survey of establishments, the story is the same, which is that at best, the size of the Pittsburgh workforce is basically at its pre-pandemic level, if not below it. So, I mean, we can't necessarily take solace in any, one particular side. We have had a below-average recovery. We have these demographic issues that look poised to persist over the longer run. But whether we're looking at people who physically work in Pittsburgh or the greater Pittsburgh, the 8-county area, or people who live in that area, the numbers, are below average and basically lower than they were before the pandemic.
And I think the 3 people that are left at the BLS will have those numbers out very shortly. Another question.
This is the first time in a couple of years that you've seemed, in my view, to have felt a little bit of uncertainty about the federal deficit and the payments on that deficit. But this group here happens to live in a city, a county, and a commonwealth that don't just have deficits, they have structural deficits. And I'm not sure how we grow our way out of that. Does it become the chicken or the egg? How do we get a workforce to come here if we have to keep raising taxes, and how do we get enough revenue to address those structural deficits?
Yeah, no, I mean, the problems here, because of the demographics, the problems here in Pittsburgh and Pennsylvania and in Allegheny County are more pronounced than in the rest of the country. We have an older population that, requires services. They're not working, so they're not contributing to the tax base through income taxes or, the local income taxes and so forth. So that's an even bigger problem structurally here. And whether we're talking about Allegheny County or talking about the state, they try to paper it over, right? They bring in, we were talking about legalization of marijuana, more gaming, that kind of thing. We need to take a look more broadly at what services are we providing. What is our tax base going to be, not just in 2026, but over the longer run, and what do we expect to happen there? And how can we, create a tax base that doesn't discourage investment, doesn't discourage businesses from locating in Allegheny County or in Pennsylvania, so that we can build up the tax base over the longer run. But our problems are going to be larger here than they are nationally. And I think to some extent, the political structure is that, particularly, and this is not meant at the current administration or anything like that, but the governor is only going to serve for 2 terms, and so the governor has an incentive to take actions that will kind of push things out to the next person without addressing the underlying structural issues. And so there's an incentive there to kind of just keep on pushing it out further and let the next person handle it. And so I think that the structural problems get papered over and continue to fester and if anything, get worse over time. Don, I don't know if you have any thoughts about.
Well, I think one of the things, the benefit of being a recovering academic of a certain age is I've accumulated a huge amount of paper and studies from the past, and I keep them. And so one of the things we had here is Paul O'Neill led the competitive Pittsburgh task force probably 30 years ago. Came up with some great suggestions of ways to make city government more effective and less expensive, almost none of which got implemented. At the state level, Governor Thornburg slashed the state payroll dramatically without impacting services, because Pennsylvania used to have the highest taxes and a deficit and other negative kinds of economic characteristics. So it can be done. It takes the will, it takes the leadership. The private sector has to get involved and help to drive it. But you look at the increase in the state budget, it's dramatically outpacing inflation. We can't keep spending and spending and spending and expect that it's all going to work itself out. So I think it is actually time to really start worrying personally about the state budget and about the city budget. I feel sorry for Corey, who's a great guy and has great attitude and great energy, but he's inheriting a mess. And we all need to understand it needs to be addressed.
I follow a couple other economists, and one of the comments that you mentioned, Gus, at the end of your presentation, you put at a 1 out of 3 chance of a possible recession coming up in the next period of time. A few other economists have noted that without the race to the AI boom and data centers, the economy may already be in recession. It's just being artificially inflated due to the construction, supply chain, and ultimately the development of these data centers. Have you looked at any of that data, or do you have a reaction to some of that as part of your analysis?
Yeah, I think that the counterweight to that would be that we're still seeing solid growth in consumer spending that makes up 2/3 of the U.S. economy. So when we look at that, when we look at consumer balance sheets, the labor market has definitely softened. I'm concerned about the breadth of job growth. Over the past year, more than half of the job growth has come basically from healthcare. That's not sustainable over the longer run. But when I look at the state of consumers in particular, and I think it's more, the high-income consumers doing well because of the stock market and so forth. I don't think that we are seeing a recession in the economy outside of tech. I am concerned about our dependence on tech. I'm concerned that particularly if we see a big decline in tech prices in the stock market generally, that could cause consumers to pull back. And I think that's a big reason why that risk of recession is higher than it would be under, quote, normal circumstances. But I think that there are some other strengths in the economy that are out there besides the tech that we're seeing.
Gus, Don, thank you again for doing this. Really appreciate it. Round of applause. Thanks, everyone. Have a great rest of your day, and Happy New Year. Thanks, everyone, for coming.